Hey everyone, Steve Engel here again with Asbury Capital. I want to make this video because a lot of interesting stuff's been happening in the market recently. It's kind of seeming like the IPO market might start picking up here in the near future. So companies like Databricks, Stripe, some of the biggest ones out there might be going public soon. And that could be great news, right, for a lot of their employees that have equity in the company. Now, what's interesting about it though, is these are private late stage companies. So what's different about having RSUs or restricted stock units in a private company is there's usually two things, unlike one, that need to happen for you to get your money out. So instead of just the one thing happening where you just need it to vest, right? You have to wait a certain amount of time for you to actually get ownership of the shares and you be able to sell it immediately into that public market. With a private company, you can't do that because there's no one to sell to. So you have to wait for the second trigger, which is a liquidity event. That could be an IPO, a sale of the company. That could be something called a tender offer, where the company raises additional cash from outside investors, giving the employees the ability to sell their shares into it. That's actually what Stripe did earlier in the year, right? And it came out of nowhere. So having a game plan for that is something that I'm helping a lot of my clients with now, because you don't want to wait and be reactionary afterwards. You need to know how much additional money from that sale you need to withhold for taxes, because they never seem to withhold enough, and clients are left with a gigantic tax bill in April. You also need to know how much to sell of it, right? How much you potentially might want to keep in the company if you really believe in it. You also need to know, probably the most important part, is what to do with the proceeds afterwards in the most tax efficient manner, right? How to invest it and diversify it, because if a lot of your net worth is tied up in one company, it's really risky. Right? So you need to know what's the most tax efficient way to shift it out, divvy it up, and everyone's goals are different. So a big part of that is the answer is never the same for everyone, because every client has different goals. So it just depends on what's best for the client at that point, and that's what we help with. So as per usual, if you have any questions, don't hesitate to reach out. You can just go to our website, asbury-capital.com. Check us out on Instagram as well, and give us a shout. Thanks.